dollar down, bonds down, yields up, and stocks down. So this chart might seem a little technical, but I just want to walk you through it. So I've highlighted two red sections. This is something that's referred to in technical analysis as the death cross. And that's when the moving averages. So you've got that purple line, which is the 50-day moving average. So it's a moving average of the price over the last 50 days. And obviously it goes up and down, but it more or less is a predictive kind of directional instrument. And then you've got the longer 200-day moving average, which is always a little bit lower because it trails on a longer time frame. Well, when you get the 50-day moving average crossing down and going below the 200-day moving average, it's referred to as the death cross. And the reason that is because it means that the market's headed down over the medium term, short term and medium term. So the last time we saw a death cross in the S&P was back in 2022. Okay, and you remember how busy we were then. Yes. People were down 20 to 30% that year. Okay. Now, not to say it didn't recover, but it was a very volatile year for both stocks and bonds. Well, we're seeing that now, okay? But this death cross is only happening this past week. We're already down, you and I mentioned, anywhere between 10 and 20. I say 15 and 20, depending on what you're invested in. So far this year, we're down by 20%. If you draw a line from the low at, let's say, 5,000, and today we're at like 54, take that across the chart, we essentially have wiped out all of the stock market gains in the last 3 months. We've wiped out all the gains from the previous year, okay? So 2023 was a great year for stocks, up by 20%. 2024 was a great year for stocks, up another 20%. 2 consecutive 20% years is almost unheard of, right? Like annualized returns on the stock market should be 5 to 7%. Going back hundreds of years, that's what you see. But we had 2 amazing years in the stock market. Well, it's gone. The blink of an eye. Everything that we saw in 2024 is gone now.
3 days, the stock market trading for 3 days, a year's worth of gains gone.
That's it. So, what I don't understand is we're technical guys. We live and breathe this stuff. We follow finance, we follow stocks, we follow stuff because it's instrumental to our business. We can take it for granted that we live in this space. Most of our clients don't. They got families they're taking care of. They're going to their jobs. They've got busy lives. I get that. That's why they want to listen to us. That's why they want to know what the key areas are that they need to pay attention to. These few that we're covering this morning are them. But what I don't understand is, sure, we're steady, right? We're steady right now. But if I can be a little bit, blunt here, we are nowhere near as busy as we should be because American investors are still focused on the stock market. Okay, we have a 15 to 20% decline. It's probably about half of where we're going to end up at the end of this year. I suspect we're going to be somewhere down between 35 and 45%. Okay. And knock on wood, I don't have a crystal ball. We can come back on and do a review later this year. But my guess is we finish the year with the general stock market being down between 35 and 45. So we're halfway there. This death cross, which is happening now after 3 months of the stock market correcting, is really only this is kind of saying things are only just getting started. Like the decline in the stock market is only starting as of now on a technical basis. So if we bring up my chart, I want to just walk you through a couple of different things which show you that we're nowhere near the American stock market kind of reflecting the amount of danger that's actually present in the stock market. So this, just as an example, are the S&P 500 companies' earnings. Okay, they've been revised down to the lowest point not seen since COVID, when we had an economy that was entirely shut down for months on end. So the S&P is now revising earnings to the lowest point in over 5 years, and yet people are pouring into the stock market like crazy. And I'm going to prove to you that that's what's happening. Let's go to this next chart. So, and then we might just have to, I want to touch on this. We've talked about the swings, right? The swings in the stock market have been crazy. We had 3, 5 to 6% down days. We had one day last week where the stock market was up 10% in a single day, just to lose it all within the next 2 trading days. So the stock market, which is normally as steady as she goes, you get your 5 to 7% annualized. Right now, it's a yo-yo. It's up, it's down, it's just It's got the same, it's crazy. And it actually has right now on a volatility chart, what this shows you is orange is the volatility of Bitcoin, okay, which we know has had crazy swings, crazy up, crazy down. You expect that from Bitcoin. It's a little bit more of a speculative market. It's smaller. It's not seeing tens of trillions of institutional money flows, right? It's not the U.S. stock market. But the white line is the U.S. stock market. It has the exact same. They're now on par in terms of their volatility in 2025. They are both trading like yo-yos, okay? That is not an environment in which you should leave your 401k or the bulk of it or your retirement account or your Roth or your IRA or anything like that. So it's just crazy to see the types of moves that we're seeing in the stock market, which should be a generally quiet and confident market in good times, which of course we're not in. But this next chart, sorry, I'm going to catch my breath here, is showing you retail investor inflows. Where are retail investors going right now? Well, because of their financial advisors, we can talk about this a little bit. All they ever do is recommend the stock market. Doesn't matter how much blood is in the street. Doesn't matter how much volatility is there. It doesn't matter what's happening with bonds or with stocks. Most financial advisors are always going to recommend, hang on, sit tight, put more cash into the market. Time in the market's better than timing in the market. And while that's generally true, there are certain setups that are just red flag after red flag after red flag. Despite all those red flags, retail investor inflows are still now just pouring in at record levels into the stock market, like lambs to the slaughter, in my opinion, okay? We should not be seeing more money pour in after a 20% correction when all of the things show you that this is just the start of a larger, maybe multi-year bear market. This isn't necessarily a 20% down and then back to all-time highs and forget about it, you're good. No. It's being treated that way, but we're actually coming into a structural, fundamental, global financial system change that is actually now probably the beginning of a larger, deeper correction, kind of like a 2008 or worse. But what are investors doing? They're asleep at the wheel. They're pouring in to stocks like there's nothing wrong. Like none of these red flags are up and waving right in front of their face. And maybe they're not paying attention. And I don't mean to sound disrespectful, but they're just not reading the signs, or they're not being given the proper advice.
Yeah, and that's kind of par for the course here, right? I mean, I've in the years that I've been doing this, I've always noticed that, people tend to crowd a trade when it's going up, and they tend to leave a trade when it's going down, right? So the
investor sentiment, right?
That's
exactly follow the crowd.
Right.
Follow the crowd.
That's exactly right.
But if everyone's driving off a bridge, my dad always said, like, just because your buddies are jumping off the bridge doesn't mean that you should, right?
No.
I think part of it is like a fundamental kind of systemic error with the way that like financial planning is done. Most people buy 70 or 60% of stocks and 30 or 40% of bonds, and you set it and you forget it. ETFs now are more popular than ever before. Passive investing accounts for a very large portion of the total stock market. Active investing and actually stock picking is almost a dead profession, right? But people are being, again, led like lambs to the slaughter, saying, hey, look, the market might crash next year, but just wait it out, ride it out. It'll always come back. Well, Josh, there are periods, as you know, where the stock market can do nothing. It can go down or sideways for 10 or more years. Like the NASDAQ in 2001 crashed. It didn't do anything or recoup its high from 2001 till 2013. Okay, that's fine if you're 25 or 30 or 35. But if you're 60, you are lining yourself up to have your portfolio obliterated by half and stay that low for 5 or 10 years, which you probably can't afford to do if you're relying on that income, right? Like I got lots of clients who pull a little bit of money out every month, every quarter, make ends meet on top of Social Security, and that's okay. Like that's what retirement's for, right? Is to help you make ends meet and to live a great quality of life in your retirement years. Well, I'm sorry, but if you are strapped in, buckled up, and headed into a collision, like this is actually like a kind of a disaster scenario, you are really setting yourself up for some major pain. Yeah. Major pain when you're down by 30 or 40%, like I predict by the end of the year, and maybe worse. And then you've got to wait how many years for that to come back?
That's right. I mean, investors, I think, have a short window right now to take the gains, take some chips off the table in the stock market, and convert it into an asset that is, historically more undervalued, historically does better in these types of environments, right?
Yeah.
You're not stuck in the stock market, right? Everyone thinks that you're stuck in the stock market and you have to ride these waves out. And that's not
Right.
the case.
Absolutely. Absolutely. And I think, look, nothing against financial advisors. And of course, we're biased, right? We're both precious metals investors, have been for a long time before we ever even started working for Noble Gold Investments. Okay. Like I've been buying for 8 or 9 years. I've been working here for 4.
Yeah.
I live and breathe this stuff. I love it. I'm an investor first, sales guy second. And I tell people, look, there is a bias. I work for a gold company. I'm invested in this stuff. I walk the walk. I talk the talk. Of course, I don't have a non-bias, but I am trying to give you all the facts and backing it up with data, backing it up with charts. But financial advisors, they don't want to sell you anything that they can't profit off of either, right? So when you go to your financial advisor and ask them, hey, I'd like to, put a little bit of my portfolio into gold, they're going to look at you and say like, what? Like, what are you talking about? It's like going to a Chevy dealer and asking them what kind of Ford you should buy. Okay. They're going to tell you they can't, you shouldn't, and all these other reasons why. You don't ever recommend that somebody buy something you can't sell.
That's right.
But regardless of whether it's Noble Gold Investments for physical precious metals IRA or any other type of metals investment that you can get your hands on, diversification and protection for your portfolio into the precious metal space is an essentially important question that you have to ask yourself. Like, how much? That's a question for each person, case by case. We work with clients to figure out what makes the most sense for them. But you cannot ignore this space. It cannot be ignored. And unfortunately, most people won't realize what's happening in terms of like the big macro shifts and where the stock market's going, where the economy is going, where the metals are going, until it's a little bit too late and they've already lost 20, 30, 40% of their portfolio.
Yeah, that's right.
So
something to go over too about the advisor point. So a lot of people don't
Please.
understand this. So how financial advisors, money managers make money is a percentage of assets that they have under management. They get paid out, right? If you do better, they do better. And then some of them have a set fee, but anyway, it's usually anywhere from 1% to 2% that you're paying of the account value every single year to a financial advisor, right? When you buy gold and silver, you pay a one-time commission and the gains are yours forever, right? It's not like you're paying Noble Gold every year to make sure your gold stays gold and your silver stays silver, right? There's no management fees. There's no 1%. There's none of that here on an annual basis, right? Which is something that when our clients talk to their financial advisors, they never hear that it's a good idea to take money out of the advisor's pocket and put it into gold and silver, right? So there's an extreme bias there. And I've talked to hundreds, thousands of advisors over the years, and I have yet to meet one that thinks buying gold and silver is a good idea. They didn't think it was a good idea at 1,000. They didn't think it was a good idea at 2,000. They don't think it's a good idea at 3,000, right? I mean, it's like it's a broken record.
Exactly. And I think I saw this stat, and I wish I had a chart to back it up, but something like the total percentage of gold holdings in American portfolios right now is less than half of 1%.
That's correct.
It's insane.
Yeah, most gold people own is on their wedding band, and that's it.
Right. But in 1980, gold had a total global portfolio allocation on average of 8. So to go from 0.05 to 8 is a 16 times multiple in the market cap. And we're probably going back to that. I think, again, China selling bonds, dropping dollars to buy gold, which is one of the main reasons why it's driving the price up so high. Yeah. We're early days. $3,000 gold is nothing compared to where I think we're going.
And that's retail, right? What are the central banks doing, right? How have their positions of gold and silver gone up over the last in the same time frame, right? I mean, central banks are loading up on gold and silver all over the world, from China to Russia to even here in America. We're seeing a huge rush to gold, while the retail investors are going into the stock market or selling their gold, right? I mean, I remember mentioning this to you the other day, right? I talk to, gold and silver buying coin shops all over the country. And, they're telling me that it's a 10-to-1 ratio right now, which is mind boggling to me. So for every 10 people that come in there to sell, one person's coming in to buy.
It's outrageous. And our ratios aren't as high because there's a lot of education that goes into why you're buying your metals and for what kind of time horizon when our clients originally come in. But we see a lot of selling now too. Look, gold is at all-time highs. It seems like a good idea and a good time to sell. But the price action that we talked about, like gold is $2,500 at Christmas. It's $3,200 now.
That's correct. Can you imagine if you sold at Christmas? You think, hey, I'm just gonna, it's at close to all-time highs. I'm gonna sell. I'm not gonna worry about it. You get back into the market.
But
now you're down 20% in the market while gold's gone up 20-30% in that same time frame.
What's driving that is governments, central banks, billionaires, hedge funds, and all these other large institutional buyers. This smart money, if you will, okay? And I'm not calling retail investors dumb or dumb money, but frankly, watch what they do, not what they say. If you listen to what they say, they want you to think gold's a barbarous relic, no yield, no nothing. No, it's not a business, no earnings. Okay, fine, but it's considered money. It's a tier one asset going back 5,000 years. There's a reason that everyone is buying this. Everyone with money to protect, they're buying it because the writing's on the wall that the plumbing of the financial system globally is about to change. Whether that's the gold revaluation happening from the U.S. government or some BRICS currency catalyst, they want to own gold because it is money. It will always hold its value. Currencies, as we know, are depreciating like crazy, US dollar included. And long-term debt is not something you want to own when we're going into a massive recession and probably a sovereign debt crisis, not just for the US, but for the whole world. And so, the idea that we're probably going back to some type of global gold standard, which, by the way, we were on prior to the Great Depression, right? The only reason that every single country came off the gold standard in the 1930s is because they needed to print money to stimulate their economies during an insanely difficult economic time. So they were constrained by a gold chaperone to their money supply. They came off it so they could print, and put it all into the markets to be able to sustain. But now it's the opposite. We've been on a fiat system globally. Every single country in the world is on a fiat currency system for the first time really ever, right? These last 50 years, it's the only time in history it's ever been done. And now everyone's going back to gold. Why? Because we're probably going to have a sovereign debt crisis that's fueled by a currency crisis when they print so much money. I have no idea where inflation is going in a few years. And when it all blows up and gets reset and there's a debt jubilee or whatever it is where everyone gets back to par, they clear the decks of all the debt and they reestablish a new world order, not to sound like conspiracy theorists, but that's where this is going. Gold's at the center of that. Okay, and then again, watch what they're doing. Billionaires, financial institutions, hedge funds, banks, governments, and central bankers, central planners are all buying this stuff, yet retail is being herded into the stock market like lambs to the slaughter. So at what point, I want to go to this next slide too. This shows that everyone's still pouring into the stock market. This next chart actually shows you that speculative appetite amongst retail investors is actually at an all-time high as well. This is inflows into the NASDAQ 3 times leverage ETF, which is like if the NASDAQ's up 5%, this thing's up 15. But it also works the other way around, right? If the NASDAQ is down 20%, this thing's down 60. But we have record inflows into these extremely leveraged triple leverage ETFs, which is just, again, how are they not seeing where this is going and that this is like all the ingredients for an absolute disaster?